Welcome to Quantitative Methods. In this lesson, we are diving into one of the most fundamental concepts in finance, rates and returns. Understanding how to interpret and measure these is critical for your success on the CFA Level 1 exam. We have a lot to cover. We'll start with the interpretation of interest rates and the components of risk premiums. Then, we'll master various return measures, including arithmetic, geometric, and harmonic means. Throughout, we'll work through practical exam-style questions to ensure you can apply these concepts under pressure. Hi, I'm Brandon, your Everest AI coach. If you're new to finance or coming from a non-technical background, don't worry. We're going to break these concepts down step by step. Let's start with how we actually look at an interest rate. It's not just a cost of borrowing, it's a decision-making tool. Interest rates can be thought of in three ways. First, as a required rate of return, the minimum you must receive to accept an investment. Second, as a discount rate, the rate used to find the value of future cash flows today. And third, as an opportunity cost, the value you forgo by consuming today instead of saving. The nominal interest rate is the sum of 5 components. We start with the real risk-free rate, then add an inflation premium to protect your purchasing power. On top of that, we add premiums for default risk, liquidity risk, the cost of selling quickly, and maturity risk, which accounts for the sensitivity of long-term debt to rate changes. Let's look at a practical example. Suppose we have a real risk-free rate of 2% and expected inflation of 2%. To find the nominal rate for a risky bond, we add the premiums, 1% for default risk, 0.5% for liquidity, and 1% for maturity. Adding these up, we arrive at a nominal interest rate of 6.5%. Once we have the rates, we need to measure how our investments are performing. Financial assets typically generate 2 types of return: periodic income, like dividends, and capital gains, or losses from price changes. Let's look at the holding period return. The holding period return, or HPR, is the total return for a single period. You take your ending price, subtract your beginning price, add any income received, and divide by that beginning price. It's the most basic way to see what your investment earned from start to finish. Here's an exam-style question. You purchase a stock at $34.50, receive a dividend of $1.55, and then sell it for $30.50. What is your holding period return? Take a moment to think about which formula applies here. To solve this, we take the ending price of $30.50, subtract the beginning price of $34.50, and add the $1.55 dividend. This gives us a total gain of -$2.45. Dividing by the initial price of $34.50, we get a return of -7.1%. HPR is great for one period, but for multi-year performance, we need averages. The CFA curriculum focuses heavily on the difference between arithmetic and geometric means, especially because one is always biased when returns fluctuate. In this example, 3 annual returns of -50, 35, and 27% give an arithmetic mean of 4%. But because of that big negative year, the geometric mean, which shows the actual growth of your wealth, is actually -5%. This is why the geometric mean is the gold standard for reporting historical performance. One of the most important distinctions you'll face is money-weighted versus time-weighted returns. Think of it this way. Money-weighted is about the individual's result, while time-weighted is about the manager's skill. Consider an investor who adds a large sum just before a market rally. Their money-weighted return will be high because more funds were invested during the high-growth period. However, the time-weighted return stays the same regardless of when the investor added money, which is why we use it to evaluate fund managers fairly. Using the internal rate of return method, we find the money-weighted return is 26.11%. In contrast, the time-weighted return is only 10.76%. The difference reflects the impact of the investor's timing, a key concept for you to master for the exam. Now, how do we compare a return earned over 1 month to one earned over 3 years? We annualize. This puts every investment on a level playing field, no matter how long the holding period was. If you earn 0.4% in just 15 days, What's your yearly rate? Using the annualization formula, we compound that 15-day return by the number of 15-day periods in a year. The result is a 10.2% annualized return. It's a powerful way to compare short-term opportunities. Finally, remember the difference between what a manager earns, the gross return, and what you keep, the net return, after fees. Also, always distinguish between nominal returns and real returns, which subtract inflation to show your true increase in purchasing power. Let's calculate a real return. If your stocks earned 8%, but inflation was 2.1%, your real return isn't just the difference. Using the exact formula, we divide 1.08 by 1.021, giving us a real return of 5.78%. This is your true growth in wealth. We've covered the core of rates and returns, from basic interest rate interpretations to complex performance measurements. Mastering these worked examples will give you a significant edge when you face these questions on exam day. In our next module, we'll dive into probability and risk measurement. Keep practicing these calculations, stay focused, and I'll see you in the next lesson. Good luck with your CFA preparation.